missed it, they can get the live. All right, guys, wanted to come at you guys with a live update here locally in the Tampa, Florida market. Just talk to you guys about what we're seeing. We're going to be putting a series of these together from most of our TBREIA sponsors and people that we reach out to and work with on a regular basis. And I know you guys have all been inundated right now with a ton of information. There's been webinars, like I feel like there's been 10 of them a day. And so a lot of this stuff has been overwhelming, and you don't really know where to start, right? And that's obviously a problem for a lot of people. And so we wanted to bring you this in a quick format so that you guys can get the meat and potatoes and not have to be stuck in analysis paralysis mode, because I have a feeling a lot of people are like that right now. So I want to introduce you my guest today. Today we're going to talk about current closing trends and some of the investment stuff we're seeing. I've got one of our sponsors, Old Tampa Bay Title here. I got Ralph Zeiler and I got Andrew Hook, or is it Hook, sorry, right?
Hook, yep.
Hook, yeah. You should just spell it funny. And I got Sam.
Talk to his mom and dad about that, okay?
That's right.
Or his great grandparents, maybe. And I've got Sam Alley from HIS Capital out of Orlando. We're going to talk to you guys about what we're seeing locally here. And these are going to be 15 to 20 minute snippets. Again, I don't want this going on for hours like a lot of these things and taking up too much of your time. So welcome, guys. Let's get this thing rolling here.
Yeah, absolutely. Well, I guess, Greg, maybe the best thing to do is, we talked about this last week, and I thought maybe having Ralph and Andrew out to talk about what they're seeing on the title side, because let's face it, we're in the investment space. We're we're out there buying properties, we're wholesaling properties, we're trying to get deals funded, and who better to talk to than those guys that are on the front line, right? Watching what's happening come across their desks. So that's probably our best place to start, to bring out Ralph and Andrew and, what are you guys seeing, right? So, part of this is
exactly what's happening with these closings right now. Are you guys having closings, fall apart? What are you guys seeing really right now?
I think, go ahead, Ralph.
Go ahead.
Let you kick it off. Okay.
Go ahead.
So I would say we're still closing deals. The new pipeline build is where we're seeing the potential slowdown. I don't think that's unexpected. There's fewer and fewer people out, more people on lockdown, of course. So we're not thrown by that. We've been busy with sort of the start of the year. Q1, early part of Q1 pipeline is what we've been working our way through. So that's what's closing. I would say that we saw early on, probably, when all of I'd say when the NBA season started getting canceled, the MLB season being put on hold, that's when we started to see some knee-jerk reactions. And I think personally, we saw that more in the commercial or early on in a due diligence, LOI status, or even preliminary due diligence without any type of hard or money that had gone hard at that point. Those were the deals that we saw the initial knee-jerk pullout on. We pulled our numbers as of today, and I would say the best word to describe it is a disruption rate, because most of the deals have not formally canceled. They've either extended or there's been some change in terms to continue forth with that deal. So we've seen about 10% on that disruption rate. Most of it is coming from the lending side, honestly. We've had about 3 to 4%, which have just been what I call cold feet scenarios, where people putting a halt, saying, I'm not comfortable with, what we're seeing. We want to distance ourselves, let the dust settle a little bit and figure out what we're working with moving forward. But the disruption rate, I would say, is more kind of in line with either people were getting to the day of closing and loans were falling out. That's been happening either through verification of employment or changes in lender requirements or what loans are actually available to be funded. But as I said, most of them we're seeing get reworked, which is good news, and will come back ultimately to the close table. It's just going to take, another few weeks to get it there. So.
Okay. What are you guys seeing when it comes to like lien searches and stuff like that? I know because some of the municipalities have slowed things down with searches. What are you guys seeing with that?
Yeah, so I'll go ahead and talk on behalf regarding the kind of the operations and what we're seeing. I mean, at this point, the biggest disruptor I would say for investors with closing on time essentially is regarding the code enforcement. So right now, the code enforcement and anytime at turn time, I mean, we're looking right now currently at about 21 days. Regarding title, we're still getting that back within 72 hours or so, 48 to 72 hours. The other thing as well regarding municipalities, regarding like utility, for example, I mean, right now we're still looking at about a 10 business day trend, with getting that information back. I know sometimes municipalities would allow you to kind of expedite that for a cost to be able to expedite that. But at this point in time, they're not allowing, it's not even an option. So.
Okay. So that's still, I mean, that's not terrible. I mean, it's worse things have happened. That's not a big deal. I mean, yeah, it might take a little longer, but that's, I've heard horror stories of other parts of the country that are not anywhere near as good as ours. So that's reassuring for sure.
Sure. Yeah.
Andrew, we had talked a little bit about this, with forbearance agreements. Can you kind of explain to people watching what exactly that is and how that works? Oops. You there, Andrew?
You cut out. I didn't hear what you said.
I was going to ask you if you could talk a little bit about forbearance agreements. We had talked about that last week, and explain to people what that is, because that's obviously a hot topic right now.
Sure, definitely. So right around the first of the month, of course, loans coming due, rent coming due, we were seeing a lot of need to put on tenant and borrower need to put payments on hold. So we worked our way through quite a few different forbearance agreements, whether it be lender related or whether it was, rent abatements or, and it's been all over the map is what we've seen, frankly. Some people have waived payments. Some people have, been putting 30-day halt, 60 days, some are 90, some are even been a little longer, for 6 months type scenario, depending on who the tenant or the borrower is, and then tacking things onto the back end. So we're seeing sort of creative opportunities arise as to how parties are dealing with it. But frankly, the hold that the governor's put on evictions on a residential side and on foreclosures on essentially a stay on all foreclosures is force these parties to the table to kind of talk through it and figure out a solution that's mutually agreeable. Some of our larger landlords, we are seeing some of the credit tenants actually kind of play 900-pound gorilla card, and they're just saying we're not going to pay rent for a period of time. But those landlords just kind of have to deal with that, and I think they realize the benefit of having those folks is there. So, but the good news is we're seeing most people come to the table and work through it. So.
Okay. Great, that's good news too. I mean, it's what I mean. The whole point of these things we're be doing is letting people know that this is the time of all times in the world. I know we are a microwave society where we want everything now. Everything's got to be at our fingertips. This is the time where you, me, and everybody else watching has to practice patience. And yes, deals might take a little longer to close. So what? People will be late on their rent. We almost got 10 million people filed for employment in the last 2 weeks. This is the time to take patience and learn from this and adapt and move on. But practice patience is very difficult for a lot of people, me included, especially me. But we just got to do it, and you got to work with people. And, this is time to build stronger relationships in every aspect of our lives, business, personal, everything. So practice patience, everybody. So Sam, I'll bring you in here.
Greg, I mean, honestly, man, this is really about alliances, right? Forging alliances, strategic in more ways than one. And when it comes to patience, right, I think Buffett said this, it always kind of cracks me up in stitches. You can get 9 women pregnant, still can't make a baby in a month, right?
Mm-hmm.
Right? So
I want to do that.
Well, I guess it would be fun. The fun part is the trying, right? The end result maybe not be so much fun. And that's what happens, I think, in a lot of the things that we do on a day in, day out basis. You're right. We are a microwave society, or we're dealing with wholesalers, right? We've got contracts that are contingent. They've got to close in a certain time frame. Assignment fees might get lost or whatever the case may happen. This is all going to shift. So this is about, and I'll throw Buffett around a lot, but really we get to find out who's been swimming naked, right? And who's actually got some substance to them. And yeah, Ralph and I were talking earlier, this virus in a sense is also going to cleanse our industry from a lot of different things. When I see, and I get to talk to the whole landscape, right, man? I mean, it does cleanse where wholesalers that started that aren't going to be around anymore. Or I'm getting emails from wholesalers that are like, hey, look, man, you can buy anything of mine, only $500. I'll waive all the rest of my assignment fees. So, we're seeing things like that starting to take place that, we've got a couple of months yet before some of this dust is going to settle. We're still not sure about lockdown, how long that's going to take. So this is time from a business standpoint to really start refining what you've got going on. What is your business going to look like, right? And the only thing that we should be doing right now, we've got some companies that we're working with that they've got to release people. Fortunately, we haven't had to do that yet, at HIS. But if this continues to go on longer, I don't know what that's going to bring, right? So now it's, what expenses can you cut? That always goes to salary first, right? That's what we're going to see the trickle down effect come from this all the time. And then it's what can you outsource, right? I mean, asset management is certainly a priority to anything else, right? Outsource everything else that you got going on. So focus on whatever is moving the needle forward, and whatever doesn't, it's got to go for now anyway. And you may find that you wind up doing business better because of it. So
Agreed.
a lot of this is attitude driven as well.
Agreed. So let's jump in a little bit, Sam. Let's talk about what kind of deals are getting funded right now, and which ones are not.
Greg, this is the deal that's going on in our landscape, and it's interesting what we're doing at HIS. We're fortunate to an extent that we weren't reliant upon Wall Street money. For the most part, we were, of course, to get the cheaper rates and to be able to offer cheaper rates, and I think that's a big key for all of us, man. We got spoiled. We just got spoiled, right? We got spoiled with cheap hard money rates. I mean, we funded a 30-year recently at like 5.25%, which I didn't even think was possible in our space.
Right, that's ridiculous.
Even
that's
6
good,
or 7 months ago, right? Yeah, exactly. I mean, we were at 7.5 might have been reasonable, even 8%. Some guys were happy with, for that long-term 30-year program. Getting into the fives was absolutely obscene. That tells you Wall Street really had an appetite for what we're doing. Now the sphincters are a little tight. I think what we're going to see really transpire, especially from the hard money side, and this is going to be impactful, guys. We're going back to double digits. You're going back to double-digit interest rates. I mean, when I first started in this business, what was standard was probably 18% and 6 points. So, how quickly that shifted.
But when you get the prices at, it's 50% of the ARV minus repairs, though, it's a little different. As the competition grows, the same thing. But yeah.
Yep. And those types of things. I mean, but we're going to see that, right? We're going to go back to double digits, and what's getting done now. I'll tell you the creative strategies that are taken to get some things done is now we're looking at what borrowers, they're going to be tiered. That's exactly what's going to happen in our business now. How strong are you? And that's going to dictate the lower point of that double digit rate. But we may also require now of incorporating into the loan to where you're going to come to the table with that 6 months up front. That's going to be escrowed. Loan services is going to handle that, and your payments are going to be made. You're paying your first 6 payments up front. That's going to be a way to insulate it and protect it for the investors that are buying these notes. So there's going to be some changes, the shifts that are happening now. It's going to hurt the newbies quite a bit. To where this may not be the right time for them to be getting involved in our business because they just don't have the substance or the liquidity behind them. But everything now is going to get scrutinized even more than it did before. And we vetted thoroughly, but now it's going to be on the strength, or is there collateral? Do you have extra collateral to put up at least for the next several months? That's going to be the gist of what we're going to see. There are some groups out there right now that we're working with that, there's a couple of groups that have $1 billion, but what they're going to specialize, somebody asked me yesterday, Greg, about new construction, right? Are we going to see new construction loans back? I'd like to think maybe so, but maybe not till the end of the year. But yesterday we're on the phone with a group that's got about $1 billion, and they're only looking to fund infill, ground up construction, or fund on the renovation side as long as they control the capital. So
Okay.
that's their shift, that's their niche. So that's what's going to happen with a lot of these groups. There's 3 or 4 groups out there with a few billion to play with, but it's all going to be segmented now. We've got some groups that don't want to touch Florida. They're staying away from us. Sam, I don't want any of your paper from Florida, not at all. But on the flip side, if you give me your California stuff, I'll send you all my Florida stuff. So that's the kind of bartering now that's going to be going on between lenders. And we're trying to put that coalition together to where, hey, you come to me with something that you wanted to do in North Carolina. And the timing of this really sucks for all of us, and ourselves included, because we just launched in North and South Carolina and Tennessee. But now we don't have boots on the ground there. So I'm not really going to look at that kind of paper, but I also don't want to steer that person away. I may be able to send them now to somebody that's part of this coalition that says, yeah, this is my niche, this is our market. That's kind of the play that's happening right now, which, you know, can you adapt? Can you adjust? Can you improvise? Can you be a Marine in this climate? And that's what it's going to take to survive, right? And to push a deal happening. If you don't have some substance behind you, maybe some collateral or extra liquidity, you're certainly going to be back into the double-digit interest rates. 10% would probably be the starting point, and it could go up to 15%, depending on the borrower. So that's the long and short of it. Still positive though, right?
Sam,
It's still happening. Go ahead.
Sam, what do you think the hesitation with Florida is based on? Is that job industry driven, or what are you hearing about that?
No, you know, I mean, fascinatingly enough, what scares most of the money from Florida would be the same thing that scares them from California, Arizona, Nevada, right? Everybody that got hit in 08, looking at overinflated price points, right? And not
Sure.
being able to handle that valuation side. That's a big key, right? I mean, can't tell. I mean, we've gone from being BPO driven to appraisal driven. Now the timelines for appraisals are, you know, it's going to pick up steam. You know, Clear Capital, one of the biggest vendors out there, I think some of the issues that they face now is, you know, hell, BPOs are stalled simply because an agent doesn't want to do an interior, doesn't want to walk into somebody's house. Well, the same thing goes with an appraiser, except they're going to get paid a little bit more, right? They get a few $100, you know, for doing it, but their staff is limited now. So timelines are going to go up. So now the trend is to get to the desktop appraisal and to see if that'll work. And there are some sites that are being set up to where the seller can upload current pictures and start handling valuations that way. And they're still refining some of that, you know, and we may be back to normal before that actually gets to be a working solution. But that's really the shift in what it's causing now. So that valuation problem is steering money in a different direction. So unless you've got boots on the ground, if that lender doesn't have boots on the ground in that specific zone or region, they're probably not going to fund it.
Makes sense.
So.
All right, so we got some data we wanted to share, right, guys? I know, Andrew, you started sharing some of your data on, you know, your disruption rate. You know about how many of those are difference between retail and investment deals? I don't know if you can hear me.
So I would say that we've only had on the investment side, it's actually been very low. So 2% or less from a cancellation rate. Most of those deals are, again, working their way to a new hard money lender, or it's becoming an assignment deal with a new end buyer. So same thing, it's more of an extension scenario than a cancellation. The largest cancellation we are seeing, or the largest disruption I would say we're seeing, is more on the retail side from the true, more of the traditional lending blips is what we're at least seeing. I'm seeing investment by and large kind of hold steady as far as deals getting done. The pipeline's a little slower. I think people are, again, trying to wait out, you know, is there a correction on the other side that's going to present a better buying opportunity? What is it exactly? And I think we're going to see more of that just from a pipeline issue than it is actually getting stuff closed that's currently in process. So
good to know. What do we got next here, Sam, on the list here?
Well,
We've kind of
we talked about
already. Yep.
Yeah, we kind of talked about that. And I thought, just for perspective, you know, that our audience, especially because we've got people that are involved in a variety of different avenues right now, right? I mean, what are we seeing out there? And again, it's too early, right? We've been at this for about a month, right? So impact really hasn't been felt yet. As an example, got a large REIA in Chicago. I'll leave that name alone. 6,000 members, a lot of students. They've got an educational package. So everybody was terrified because a lot of the way they were set up when April 1st came, a lot of them were going to be in the hole anyway because they weren't liquid enough, right? So everybody's expecting fire sales, or we got a few months before some of that stuff's going to happen. And that fire sale may not be as great as most of us expect, right? I mean, a lot of us have been on the sidelines waiting, holding our capital, just waiting to pounce. We got some time yet before we're going to start seeing some of that trickle down effect. And I would say probably at the end of the year, if you're holding your capital, you're going to really find some fascinating deals all over the country, right? I mean, but it's going to take a few months because we're wrapped up in who's getting their dough, who's going to get their $1,200. How long is that really going to last if this extends? All of those types of things. So we're not seeing a heck of a trickle down yet. But if we look at what our capital markets are looking like and what that transactional environment is like, right? We still do have banks making loans like Andrew and Ralph were talking about, right? It's still happening, but this is existing clients now. Who do we have in our database that's strong? It's the same thing with the Bank of Americas and everybody else. They've got this money, but they're going to go to their existing client base and who they know has been able to perform and who's shown that track record of execution with them. So there's still a lot of stability out there in our market, and private equity side as well. There's buyer interest. Let's say, the buyer interest is still there, right? For people that are cash rich and cash heavy. 1031 exchanges are going to get hit a little bit because some of the sellers that were on board to sell may not want to do that right now. Even if the money is still there, they're still unsure. So until we get that confidence level back, we've got some issues, right? And that confidence level doesn't come back until this lockdown is over. And that timeline is still not set yet either. I don't know. I'm in Chicago. They're still suggesting April 30th, but I'm betting May 15th. As it prolongs, maybe a little bit longer, right? So what does that do to us? That extends this out even further, third quarter, fourth quarter, before we start seeing that true ripple down effect happening. So tenant rosters, right? What does your tenant base look like? If your tenants were weak to begin with, you're going to be in trouble. If you had some strong ones, what's going on, right? Where we're finding, I've got landlords that are coming to me saying, look, man, I'm just tacking 3 months. I'm tacking 3 more months or 4 more months of lease on the back end. Yeah. Because I'm okay, right? Mm-hmm. I'd rather have them in here and not screaming, but I'm going to tack more on to the end of the lease, or we'll work something out. Give me a couple $100 a month if you can. We've had 2 guys that I spoke with yesterday. They're basically, and they've got 200 units apiece, basically. So they're in a dynamic to where some things are shifting to where, they can put some on the back end, but they've got to wait it out. They've got deep pockets to be able to do it. On the flip side, they're going to take some of their other inventory, refinance, put some cash in their pockets so they can make it through the storm. But those are guys that are top heavy, not, some of us that have 10 or 15 units that are going to be sucking mud here pretty quick if some things don't turn around. So you got to get that SBA loan if you have a business, or you've got to get that payment protection money happening some way, shape, or form, and working out arrangements for some of those tenants that are saying, okay, you're going to give me part of that. And that's the agreement that they're putting into their leases now. They're going to get part of this to me for their rent in order to extend this another few months. So there's a lot of creative things going on market-wise. So we'll get this quickly, but I'll get to this. This is what we should be looking at, everybody, right? What tenants are unlikely to make a comeback from this? So you're preparing your own business, right? How deep is this going to get for all of us? You've got to start thinking about that kind of stuff now. And then what happens, right? When the market demand is going to be there for us, but are we going to be ready to tackle it? Yeah. So 2-year recovery period after a health crisis? I don't know about that. I think we'll rebound a lot faster.
I agree.
Some of these other things that we're looking at, right? What is the best way to balance your short term and your long term? You still have to be thinking that way. You've got to refine your business that way, because our landscape's going to change. No matter what takes place, this shift is going to cause a lot of thinking in our industry, how things are done, right? And what we're going to be able to capitalize and thrive on through, moving forward. So it's still early, guys. So, I mean, Greg, I think one of the things that we wanted to give everybody would probably go to this, right? I mean, we could throw this resource out and you got to put the WW in. I tried going to rickmalero.com forecast and it doesn't work. But guys, you want to get to that Don't worry about the economic forecast, but you'll get that. But it'll hook you to a page that's got some resources to it. We work with a lot of the team from Motley Fool, which is a great publication. They've really got some inside information. The funny thing about it, it really is kind of cool because when you get directed to their link, you're going to a link called Fool, which I think is kind of comical. But you'll find some great resources there to navigate through the crap, because this is a government program, guys. So it's full of a lot of crap that'll make us get us to the point where part of this is designed right to not want to do it. Fuck, I'm not going through this. Forget it. I'm not doing it. Right. But you got to go after your dough. So we've got a couple of PDFs for you that break down the CARES Act, that to get your unemployment insurance, even for those of you that got bumped out of unemployment years ago. Go back and file for this, because you can get the dough, but you've got to be persistent. You got to be a pain in the ass, because just like anything else we do, right? Those that are persistent are going to stand tall, and those that fall off, leave the rest for us. Get your individual checks, get that unemployment insurance, and then, of course, we can get those PDFs to you if you want to email me or Greg. We can shoot these out to you. But you got to jump on that fast. And I mean, that's really what I'm seeing. And we're doing that same thing to our staff internally. It's just what has to happen, right? You've got to do this. You've got to put your best foot forward. And for those of you that have businesses, this is one of the things that I'll offer up to you. What we're doing at HIS is we've got connections with our local bankers. For those of you that have businesses, if you're willing to at least move an account with our bank at City National, they're taking applications. We can help you get that application done, especially for those of you that have businesses that may have to cut employees. There's some cash there for you, and we may be able to help you get that. Even if it's 10 grand, tell me that won't help you. So
for sure.
If you need that hook up, get in touch with us. We'll do what we can to get you at the head of the line.
Awesome. If you go to the next slide, Sam, everyone can get our contact information so that they can reach out to us if they need anything. Again, as always, guys, we at TBREIA, myself and our sponsors are always here to help you guys in any way, shape, and form. I've been preaching that and pushing that on you guys for years. Now is the time. Sam and Rick and all of my sponsors have we've all talked about for years now about building our strategic alliances. And Sam, you led off with that. I built my entire Flipping Real Estate Like the Pros podcast on strategic alliances. I can't stress that enough. That now's the time to keep building your relationships, reaching out to us, asking for help. It's, everyone needs help right now. I don't care if you're a multimillionaire, billionaire, everyone's asking for help. So don't be afraid, don't be shy. We're all here to help each other, because none of us want to see anyone go out of business or be affected tremendously by all this. So we're here for you guys. I hope you guys got good value out of today's short webinar. We went a little over time, but it's our first one. So, we do what we do.
Yeah,
guys,
thank you. Long way.
A little bit. So guys, reach out to us. We'll talk to you guys in the next one. We'll have one next week at the same time, same place. See you guys then.
Thanks, guys.
Thanks all.
Thank you.